Hey guys, how are you all? I hope you all are doing great. So I'm also doing great. It's been a while since we caught up, so we're catching up again now. So what are you waiting for? Let's deep dive into the topic and decode this. So today we're going to be seeing about export revenue recognition in relation to the concept of India's 115. So this is going to be a very interesting guide for sure, guys, because this is something which I've seen practically. I've also spoken to a few people apart from me who've seen it practically. And in this regard, I would like to thank my friend Vishwa also, who gave me a few other valuable insights apart from what I had in my mind. So big thanks to him as well. So what are we waiting for, guys? Let's deep dive into this concept and decode this. So I'm just presenting my screen and it will be visible in a few moments from now. So just a moment, guys. Okay, great. It is visible now. So first, let's take the scenario. Why is export revenue recognition a complex term or a complex concept which many people tend to think? So guys, let's take a very simple scenario. Let's say there is an FMCG company like ITC. So let's say ITC has a very popular brand of biscuits. Like Sunfeast is a very popular brand of ITC. Let's say ITC feels that there is a good demand for Sunfeast outside India as well. So ITC decides to export Sunfeast biscuits to a country. Let's say ITC decides to export the same to somewhere like a Japan. Okay, so ITC wants to export this to Japan, right? So in such a scenario, what would happen is ITC would need to arrange a transporter to facilitate them to do the same, right? Let's say ITC takes the help of a popular shipping company like Damco. So in such a scenario, what would happen is ITC would have to incur a freight cost in relation to Damco. So would ITC do that for free? No. Obviously, whatever freight cost ITC is incurring towards Damco, they will load that to the customer. That is, they will load it to the final customer because obviously everyone is doing business here and no one is doing charity. They will obviously look to recover every single cost that they're incurring. Perfect, logical, right? Yes. So here we need to decode whether the freight service which ITC is indirectly rendering and the Sunfeast biscuit which ITC is supplying, are these two separate performance obligations or a single performance obligation? So this is the topic that lies right in front of us and we've got to give the final verdict at the end of this video. So what are we waiting for? Let's correlate this first with the bar text of the standard. Let's see if the performance obligation conditions are satisfied and then take a call and then decide whether this is a separate performance obligation or it's a single performance obligation. So yes. So guys, for a performance obligation to be distinct, there have to be two conditions which need to be mandatorily met. Mandatorily met. So first one is the goods or services are capable of being distinct and it should be separately identifiable from the other promises in the contract. So first let's take our transportation service. Is it capable of being distinct? Okay, so these are the scenarios where the goods or services are capable of being distinct. So let's come to this condition here. The good or service is sold separately by the entity or by others, or customer has already obtained from the entity or through other transactions or events. Okay, so let us say the customer is getting the biscuits from ITC. Okay, the customer can also get the shipping service from Damco. Yes, the shipping service is a service that is openly available in the market, which is provided by the players in the market. Yes, so the customer can obviously get the shipping services also. He can also get the biscuits, right? Perfect, logical. Okay, let's come to the second cumulative condition, which is being separately identifiable from the other promises in the contract. So it provides a negative list here. So it has to be separately identifiable from the other promises in the contract, which includes significant integration services not provided. So are there any significant integration services like are transportation and goods a significant integration service? No, guys. So if you look at the standard examples also, significant integration service referred to those services which are usually in relation to a construction project or in relation to a big plant where you as an entity do everything from A to Z. So you don't do anything like that here, right? So this is not a significant integration service. Next, one good or service does not significantly modify or customize the other good or service. Again, this is more in the context of a software and a hardware. Like let's say you configure a software on a device, it is going to obviously change the features of a hardware or make the hardware play to its tunes. So again, this is not the case because this is not a software hardware. This is transportation service and goods. The last condition, goods or services are not highly interdependent or interrelated. So can we say that transportation and the goods are interrelated? Yes, they are interrelated. Are they highly interrelated? So we have to exercise some bit of professional judgment there. What India's one, or if you just theoretically read India's 115, you will say that yes, they are highly interrelated and yes, it is a single performance obligation. So that is, you have to recognize the freight revenue and the goods revenue at the same point of time. No, guys, we cannot proceed with everything theoretically because it is logical to split it and it is highly possible to split it. You can practically split it. There are entities which are actually splitting and doing this, and it is also legally important to split this. So To find the answers to why it is important to split, why is it legally important to split, and how can we split, let's deep dive now. Let's understand a few things and come back here. Okay, so let's take this example. Let's say entity XYZ sells goods to entity ABC. Let's say, I'm just zooming this a bit. Let's say the invoice value is INR 100. Let's say entity XYZ arranges a transporter entity DEF to provide freight services. Let's say the actual selling price of the goods is only INR 90 and additional INR 10 is charged as that is the amount incurred as an expense towards the transporter. And let us assume for simplicity that the standalone selling price of the goods is INR 90 and let's say the standalone selling price of freight is INR 10. So guys, as I told you here, again the entity is loading the cost that it is incurring to the final customer. Perfect. So basically, if you understand this here, so the 100 is bridged into two parts: 90 in relation to standalone selling price of goods and 10 in relation to the standalone selling price of the services. So the question which we have in front of us is whether we have to recognize this revenue of 90 and 10 separately, or we have to recognize the 100 at one point of time. If we have to recognize it separately, on what date should we recognize it separately? And if we have to recognize it together, on what date should we recognize the same together? So these are the questions in front of us. So let's read the scenario a bit further and decode. Let's say the goods leave the factory on March 23rd, 2025. So the intermediary one point, I'm not reading this. I'll read this subsequently, don't worry. And let's say the goods reach the customer on April 2nd, 2025. Very simple. So what we are trying to say is the goods are leaving the factory, that is ITC's factory, on March 23rd, 2025. And the goods reach the customer in Japan on April 2nd, 2025. Perfect. Yes, sir. Perfect. So we need to understand something called Incoterms here, guys. So what are Incoterms? So Incoterms are basically the terms that are used in international trade, which provide us a glimpse of when the risk and reward gets transferred and who has, and in some cases as to who has to bear the cost, insurance and freight, and up to what point. I hope you understood this. I'll be explaining every Incoterm in an elaborate manner. Don't worry too much, guys. So let's go into this. EXW. What is EXW? So for those of you who have not heard of it, EXW is basically Xworks, guys. Xworks means whenever you as a supplier supply goods to your customer, the point in which the goods leave your premise, that is the point when the risk and reward gets transferred. So the recent Incoterms definition also defines this as Xworks. So the moment when the goods leave your factory premises, that is when the risk and reward is transferred. And as per India's 115, whenever risk and reward gets transferred, you have to recognize revenue at that moment. So if you see here, on March 23rd, 2025, the goods leave your factory, and that is the particular moment when you have to recognize the revenue in relation to the goods. So as we saw here, you cannot recognize the revenue of 100 immediately, guys. What is the logic? Because the standalone selling price of the goods is only 90. So the risk and reward in relation to the goods is only 90. What about the remaining 10? So it's very simple, guys. Why do you arrange a transporter? You arrange a transporter for the goods to reach safely, because ultimately when will a customer be satisfied, or when will a customer get benefited? Only when the goods ultimately reach them, right? So when will the service actually derive its value? The transport service is actually worth the money of rupees 10 only when the goods actually reach the customer's premises, right? Perfect. So if you see here, the goods actually reach the customer's premises on April 2nd, 2025. So this rupees 10 standalone selling price derives its actual worth only on April 2nd, 2025. Perfect. Yes. So the entry which you will be passing on March 23rd, 2025, when the risk and reward in relation to the goods gets transferred to the customers, is trade receivables account debit 90 to revenue. What about the remaining 10, guys? Here you will pass the entry trade receivables account debit 10 to revenue billed in advance, or deferred revenue, or unearned revenue 10. So why will you credit deferred revenue or your unearned revenue to the extent of 10? Because the risk and reward has not yet been transferred to the customer in relation to the freight services. Because the freight services actually derive their value only when the goods actually reach the customer. So this is very important from a cutoff perspective, guys, because what will happen is the revenue of 90 would be recognized in financial year 24-25, while the revenue of 10 would be getting recognized in financial year 25-26. So what some companies might do is they might recognize the revenue of 100 in a single instance, which is not right. And if the freight component is material, it might lead to a material misstatement in relation to revenue recognition and might affect the cutoff assertion as a whole. I hope you understood this. Okay, so let's take the next scenario, CAF and FOB. CAF is basically cost, insurance and freight. FOB is free on board. So let's first complete FOB and then come to CAF. So what is FOB? Free on board. So as per the recent Incoterms definition, FOB says that whenever you load the goods onto the vessel which is carrying the goods, at that moment the risk and reward gets transferred to the customer. So at that moment you can recognize the revenue. So if you read this example here, the goods leave the factory on March 23rd, the goods are loaded on the vessel on March 25th. So when will you recognize revenue in the case of an FOB transaction? Obviously on March 25. So on March 25 you will pass the entry trade receivables account debit 90 to revenue 90, and not on March 23rd, because this is an FOB transaction in case scenario B here, right? I hope you understood this. What about the remaining 10? As I said earlier, the 10 derives its value only when it actually reaches the customer. So for the 10, you will pass the entry your trade receivables account debit 10 to unearned or deferred revenue or revenue billed in advance 10. And on April 2nd, when the goods reach the customer, you will pass the entry your deferred revenue debit or your unearned revenue debit or your revenue billed in advance debit 10 to revenue 10. So ultimately here also you will recognize the revenue in relation to the freight component in the next financial year, that is financial year 25-26. So ultimately I've explained here, revenue of 90 would be recognized on March 25, 2025 when the goods are loaded onto the vessel on March 25th, 2025, while the revenue of 10 would be recognized on April 2nd, that is financial year 25-26. So I hope you understood this. So the revenue recognition is again getting split across two financial years. I hope you understood this. So coming to CAF base. So CAF is somewhere even I got confused as a fresher, but I'll break this down. It is cost, insurance, and freight. So let's first understand this. Let's first understand the meaning of this. So cost, insurance, and freight. Okay. So let us say ITC supplies goods from India to Japan. The example if we took Sunfeast biscuits. Okay, let's say the input term which ITC has mentioned is CAF Hong Kong. So what does CAF Hong Kong mean, guys? CAF Hong Kong simply means that ITC sees transporter will bear the insurance till Hong Kong. After Hong Kong, if any damage occurs, customers insurer has to bear the same. For example, let's say there is a damage that is occurring to the goods before they reach Hong Kong port. In such a scenario, the ITC is transporter. Let's say Damco is a transporter. So Damco will have to insure the goods in such a scenario. Let's say the damage occurs after the Hong Kong point. Let's say the damage occurs either in China or in Japan. In such a scenario, what will happen is the customer would arrange an insurer after Hong Kong. So that insurer will compensate the customer. So guys, if you see here from this perspective, if you understand this here, what I'm trying to simply say is as soon as the goods are loaded onto the vessel, the customer's risk is eliminated and the supplier's risk is also eliminated. Perfect. Why? Because let's say the damage occurs somewhere before Hong Kong. In such a scenario, only Damco will have to bear the insurance. ITC need not even mind about it. ITC can just take a chill pill and relax, right? Perfect. So as soon as I load the goods on the vessel, I can consider that my risk and reward is transferred. Because some people think that CAF Japan means that till the point of Japan, ITC only has to bear the risk. No, guys, it is a tripartite agreement where they will pass on the risk to the freight company or the transporter who will have to insure it. So ultimately, if you see, as soon as the goods are loaded onto the vessel, in essence, the risk and reward gets transferred. So if you see from a revenue recognition standpoint, your CAF and FOB are literally the same. So you have an Incoterm called CAF just to differentiate the point till which the supplier's insurer will take care and the point from which the customer has to appoint an insurer. That is the only difference between CAF. Because in FOB, what will happen is as soon as the goods are loaded onto the ship, the customer will appoint an insurer. But in CAF, that is not the case. The customer will appoint an insurer only after the point that is mentioned in CAF gets crossed by the ship. I hope you understood this. I hope you got this. So again for CAF, whatever I told for FOB will hold good. So the 90 of revenue will be recognized in financial year 24-25, while the revenue of 10 will be deferred and recognized in financial year 25-26. So guys, if you don't believe me, you can read the CAF Incoterms here as per the latest definition. The last point, the risk of loss or damage to the goods transfers from the seller to the buyer when the goods are loaded on board the vessel. This is the heart of the message. This is the heart of the scenario. So if you get this right, you're perfectly fine, right? Next, the last scenario, very straightforward. Delivery at port, DAP. So DAP or delivery at place. So what does this mean? As per the Incoterms definition, this basically means that so the risk and reward in relation to the goods will get recognized only when the goods reach the customer's premise. So in our example, the risk and reward will get transferred only when the goods go into the Japanese customer's factory or Japanese customer's plant or Japanese customer's office. So if any damage occurs till that point, ITC has to bear the risk. So in such a scenario, the 90 of revenue will be recognized only and only on April 2nd, 2025 when the goods actually reach the customer. And again, in relation to freight, it will again be recognized only when it actually reaches the customer, because that is when the freight service actually gets its real value or derives its real value only on the date on which the goods actually reach the customer, right? So in the third scenario, in case of a DAP scenario, the revenue would be recognized entirely in financial year 25-26. So in financial year 24-25, the entry you will be just passing is your trade receivables account debit 100 to your revenue billed in advance 100 to your deferred revenue or your unearned revenue 100. So when the financial 25-26 comes on April 2nd, you will be passing the entry unearned revenue debit 100 to revenue 100. So you will be recognizing the revenue only and only in financial year 25-26 and not in financial year 24-25 in case of a DAP scenario. Perfect, understood. Yes, so we covered the toughest part here, and after this it's going to be a real cakewalk. So why is the split legally important, guys? So this split is legally important because you have to split and show your revenue as sale of goods and sale of services, because for services the rate of GST that is going to get triggered is different, and for your goods the rate of GST that is going to get triggered is different. So how do companies deal with this practically? How do companies ensure this? For this, I've taken a snip from a company's accounting policy to just provide you an illustrative perspective. So what does it say? The performance obligation under service contracts are installation, maintenance, and other ancillary services. This is not important for us. So in case of okay, this is where it starts. In case of transportation revenue, the company recovers cost of transportation from the customers. As I said earlier, obviously no business is not going to recover it. Every business wants to recover it. The cost is either billed separately in the invoice or included in the total transaction price. Where the transaction price is inclusive of cost of transportation, the company splits the transaction price into sale of product and sale of services. Exactly what we did above, the split of 100 into 90 and 10 based on the standalone selling price. Perfect. Payment for the service rendered is made as per the credit terms. Okay, this is not relevant for us. Okay, so again, as I told you, so how do companies deal with this practically? So this is something which, since I've come across this practically, I can tell you. So what companies actually do is, towards the year end, companies actually maintain an Excel of the freight services which they have availed, and they map the freight services which they have availed to the corresponding sales they make. So in this scenario, what the entity will be able to do is, they will actually be able to keep a track of how much is actually the freight component which they are loading to the customer, and how much is the actual goods price which they are charging from the customer. If they maintain an Excel tracker of the freight costs that are incurring, that are getting incurred, and they map the same to the revenue that is getting, and they map the same to the sales that are made against the same, they will be able to keep a track of this, and they will be able to split the performance obligation in a proper manner. I hope you all found this insightful, and I think this video was a good insightful ride for you. So if you want this Word document, you can join the Telegram channel in the description below, and you will find it there. And another thing, guys, so I've also taken a few insights from ICA's education material on India's 115. So there is a case study number 43 there, which is even more elaborate than this. I've just broken that down in the most simplest manner here in the shortest possible time. So I'm also attaching that in the description of the video. So if you want that, you're most welcome. You can just check that out. And for more insightful videos like this, do hit that subscribe button. Keep learning, keep growing, and I will meet you soon with another amazing video and a banger of video. Cheers. Good night. Take care. Bye-bye. Cheers. Thank you.